Our 2026 second half market outlook highlights resilient growth but rising stagflation risks, driven primarily by energy supply shocks and geopolitical tensions. The global economy enters the second half of 2026 at a fragile but resilient point, shaped by geopolitical tensions and uneven growth trends. In the US, growth remains steady despite rising headwinds. Consumer spending and the labor markets continue to support activity, but inflation has re-emerged as the central challenge. Higher energy prices and persistent housing costs are keeping inflation elevated, increasing the likelihood that interest rates remain higher for longer. The Federal Reserve has maintained a cautious stance, signaling that policy will remain restrictive until inflation shows clearer signs of easing. Outside the US, growth dynamics diverge. Europe is facing weak growth and inflation pressures, while China shows resilience through exports but continues to struggle with weak domestic demand. Geopolitical risks, particularly those affecting energy supply, remain a key source of uncertainty and continue to push inflation higher globally. Equity markets are balancing resilient earnings against rising macro risks. Strong corporate results and continued investments in AI are supporting performances, particularly in technology and related sectors. However, valuations are increasingly stretched and market leadership remains narrow, making markets more sensitive to changes in interest rates and inflation expectations. The US remains the preferred market, supported by strong earnings, high returns, and sustained innovation-led investment. In Asia, opportunities are concentrated in semiconductor and technology supply chains, although volatility is likely to remain elevated due to exposure to global trade and energy prices. Europe faces a more challenging outlook due to weak demand and energy dependency, while Japan remains supported by structural reforms but faces policy uncertainty. Singapore equities provide relative defensiveness, supported by resilient banks and stable policy conditions, although upside will depend on global trade recovery. Overall, equities remain supported by structural growth trends, but near-term performance will depend on inflation, interest rates, and energy market developments. Fixed income markets are being driven mainly by inflation uncertainty rather than growth concerns. Rising yields reflect persistent inflation risks, particularly those linked to energy prices. In this environment, duration risk remains elevated, favoring shorter maturities and more selective positioning. Credit markets are still supported by demand, but tight spreads limit upside potential, making income strategies more attractive. To find out more, head to our website for our market outlook article. Thank you.